where was I? Indexes. Actually, that was interesting. So another big day on the Dow, another big day of the NASDAQ pullback because it went up so much yesterday, it didn't have any more room to go. It hit 24,000, or no, probably didn't hit 24, whatever. Anyway, so it's shooting up. But Russell is having a hell of a week. You know, just because oil's none too happy about this stuff. You know, let's see. So the Nikkei also on a massive run. Europe coming back from their big downturn that we did not have at all. They went flying down in early August. We had a little dip and we came back. They're just kind of recovering from this huge drop. Germany also pretty big drop, but coming back. The VIX dying. Nobody's worried about anything. It's interesting. All right, so then we don't need to look at that because I just looked through all that. All right, we're done then. I'm tired today. All right, so let's see. We should talk about, oh, well, let's talk about, we got plenty of stuff in here. Let's talk about earnings. Oh, that's also useful in FinViz. See, there's a very useful thing about FinViz, and I don't know if it's in the free version, but you know, this is a really useful way to look at the market, especially when you have this pop-up-y thing. So like when I do go over any sector, it shows me on the chart like exactly what's going on inside the sector. So that's kind of fun. Because you know, when you look at something like, oh, Microsoft's having a bad day, how's everybody? Is it the whole sector getting hit, or is it just Microsoft? And you say, oh, look at that, GoDaddy for whatever reason isn't having a good time, probably. And also shows me a little chart. I can't point because it does that, you know. But I am pointing at GoDaddy, so imagine my finger touching it right now, and as you can see, it's had a hell of a dip. So I would go look at GoDaddy because that's kind of an interesting story. It's like, why'd they go down so much? To me, you know, website registration service basically. I think they do some web hosting too, but that would seem to be stuff that's pretty steady and boring. I mean, even if I want to register something new, constructing my, you know, using AI to construct something, I still got to register my domain. So maybe people are just bargain hunting in that sector. And obviously Microsoft down 0.79 is not a big deal, and Oracle down even 3%. And again, obviously at some point you got to take some freaking profits. It's not because anything bad happened to Oracle, it's because they're up so much. I mean, for God's sakes. I mean, look, so they've been crunching up there. They had a little triangle squeezy thingy that failed, right? You got to watch for those. So they were following their triangle squeezy thingy, and then when they got to the point of decision, it got forced out the bottom. It squirted out the bottom instead of the top, and that's obviously not a good sign, and it's kept them down for now. But look what's coming up. The 50-day moving average is coming up. So actually, things are probably not so bad for them. But we didn't come here to talk about Oracle, which has 30 times earnings, and isn't that interesting? But we did come here to talk about some other company that I forgot about, GoDaddy, GD, those guys. GoDaddy, 20 times earnings. So this whole fall is from being ridiculously overpriced. See, now we're getting a bit of a story. So GoDaddy at 20 times earnings at 140 at 200, which is 50% higher, was trading at 30 times earnings, 30 times forward earnings. And that's too much. So this fall was deserved. Earnings were okay though, right? They had a little 4% beat. Nothing world changing, but doesn't really deserve to go below 20. So that's where they're holding the line. So basically they're holding the line at around 20 times earnings. The growth is there. It's not exciting. I haven't looked at their debt situation and everything else yet, but and it's not, and like I said though, I would think it's just a steady business. So in other words, the fact that I think it's like a steady business that shouldn't change that much means it shouldn't have gone shooting up and it shouldn't have gone flying down. But realistically, it, you know, if I were to look at like a realistic drift, well, this is only a year. So I mean, geez, I mean, 20% from here would be fair. So 100 is fair. They may have been trading too cheaply for a long time. And then we go to, see, I don't like FinViz. We talked about this last week, right? I don't like FinViz for analyzing stuff, but it's a jumble. I don't want to analyze in a jumble. I like to analyze here. This is my favorite because it's organized nicely. GDD. I don't like that they show you when you're typing the thing, they show you other country stocks that I don't even subscribe to. That's kind of, you know, I wouldn't care if I subscribe to it, that's fine, but I don't even subscribe to those countries. So why do I, and if I went to look, they wouldn't show it to me because they would just say, you're not subscribed to this country. So why show it to me? I have no interest. Anyway, so once upon a time, GoDaddy made, revenues 3 billion, 3 billion, 3.8, 4, 4.2, 4.5, 4.7, 4.9. Not once upon a time. That's like nice steady revenue growth. Look at these guys. So all they got to do is keep their spending in their pants and they're going to be fine, right? Do they? Well, for whatever reason, they lost 500 million here, but honestly, they probably spent it on something worthwhile that led to the growth. I'm not going to criticize whatever they did that cost them $500 million. It certainly led them to grow from 3.3 to 4.9. So money well spent, probably. So 130 mystery loss, but I bet if you take out some one-time thing here, you'll find that they probably were smoothly making money. 242, 352, $1.3 billion. What the hell was that? What did they do? Maybe they sold some other asset. You know, they bought an asset, they sold an asset. I don't know. It's an interesting story though. I mean, there's a hell of a lot going on here. $900 million, $846 million, I mean, Jesus, they're up to $1 billion. And the market cap is, where did we find that? There it is, $20 billion market cap. So looking at them longer term, I'm now fascinated by this story. So looking at them longer term, this was probably a $10 billion market cap, and they were making, when is this up till? This is up till last year. So basically nobody believed in their growth. Oh, it's 23, this is 23. So nobody really believed in their growth because, oh, here's why. Because in 2023, people were looking at this company and saying, okay, well, you banged out 137, you spent money on the stupid thing. It's kind of like when Crocs bought whoever they bought, Hey Dude, the shoe company, and they spent $2 billion. And people thought that was a waste, and it was a waste. So they were right. You know, when companies are that kind of company that are willing to acquire and gamble, some get it right and some get it wrong. Look at Intel. Intel destroyed their business because they bought the wrong thing at the wrong time. But anyway, so here you're still being valued at $10 billion, which makes no sense. Why $10 billion for this? This looks like shit. So no wonder they didn't go anywhere. They might have had this great story and said, oh, you just wait till you see when our new thing kicks in and look what's going to happen. And nobody believes them. And then all of a sudden money starts pouring in and suddenly this is a completely inadequate valuation. So therefore, 73 was stupidly cheap because no one had faith in what they were doing. As 2023 came along, everybody started rethinking them. And then when 2024 started looking like they were going to repeat at least $1 billion, all of a sudden people are like, well, this is a $20 billion company. So boom, 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 boom. We get up to 20, then people get overexcited because they're extrapolating or whatever. That's not what the story is. The story is this is a good, solid, steady growth company. So people got too excited. Now it comes back to a more realistic level. 120 to 150 is probably the range for these guys. So it's not a compelling, exciting play, but this is a good company. How much debt do they have? And again, this is why I love these guys. They put everything that's important on the front page. There's my cash flow. There's my dividends, none, which I like, frankly. That to me is a winner. I like the fact they're not wasting the money on dividends. Working capital, don't like that. Okay, they got $1 billion in cash, but it's not really working capital, and they got 2.7 billion in debt. Not awful, but it's a couple of years profit in debt, 3 years profit in debt. So again, would I pay 20x for this? Not really. If they were selling at 15x with that kind of growth and whatever, I think it'd be much more interesting. But at 20x, they're probably running around the right price. All right, and that's what happens when I look at my stupid chart. This is why I don't look at it that often. I'm a data junkie. I used to have a Bloomberg terminal. I was literally up I was up all night long just staring at freaking numbers. It was too much. There's too much information. It's too much information. I like it too much. I just get so excited looking up all these things. So Google Meta, I mean, these are wriggles for these guys. So who cares that they're down 2%, 1%? It's like, for God's sake, they're up 50% for the year. My pals at JP Morgan, all the banksters. Now, yes, keep in mind that lower rates are bad for banks. Lower rates squeeze their margins. Higher rates are good for their margins. Pretty simple, right? So when you talk about lowering rates, that's not exactly what the banks want to see the Fed doing. Berkshire coming back nicely, and that definitely is something that's worth looking into for anybody. I don't remember. I think we might have decided it's still not right for the portfolio yet. Here's Lilly. We just bought into Lilly. Pfizer. We just bought into Pfizer. I like that sector. ISRG, United Health coming back a little bit from their damages. Still, though, the problem with United Health they've got the money to pay Trump off. That is literally my premise on them. They've got the money to pay Trump off. Therefore, they are almost certainly going to recover because did you see what happened to the Intel CEO the other day? It was a miracle. Trump was trying to get him out of the company. He said he needs to be removed from the CEO because he's a Chinese spy. He walks into the White House and suddenly walks out with Trump saying, "What a freaking guy! What a CEO! What a company!" Oh, it's too funny. I mean, for God's sake. I mean, obviously, he can't just hand him a check in public. He's got to go into the White House. It's like a bar mitzvah when your uncle pulls you to the side. He's like, "There you go, kid." He gives you a check. If for some reason he thinks you can't just hand it to him. With Trump, I can't see what the difference would be. I mean, I would just hand him a great big check and be like, "Here you go." I'd write bribe in the memo field. I mean, how ridiculous. So this is Trump bad mouthing him, and earnings weren't good either. But then Trump went on a rampage bad mouthing him, and then he just went to the White House and the things shot right back up. So I don't know what was said. I don't know what was exchanged or what favors were done. I don't even know. Maybe he is a Chinese spy. Maybe that coincided with Trump's China meeting. I don't know. But I mean, holy crap! If you live in a country where the president can suddenly decide he doesn't like somebody and starts attacking the company with absolutely no basis, no basis at all, he flip-flops 3-4 days later he flip-flops on the whole thing. So how silly is it for me to tell you what to invest in, right? Oh, I said Geo. On that basis, though, we did invest in Geo, which is a company I hate, but they seem to be in the right position. Not doing so good yet. They're not getting the love. Of course, we invested in them down here, so we're fine, but they're not really getting the love you would expect. And even after decent earnings, those are nice earnings. I don't know what people expect out of these guys, and they are trading at 10 times forward earnings. So this is what I would call a Trump-loving company. They're locking up all those immigrants for him. So that is a fun business. Building concentration camps. CR says, I have uncovered 121 short call on MU in September. I mistyped it in chat as 131. I think either way you're screwed. You have 121 uncovered short calls. Wondering if I just buy back at a loss or get called away or just buy the shares if assigned. Wow. This seems like a large amount. Okay, so he's saying on Micron that he has 121, whatever the numbers, 121 short uncovered calls of September 130. So they're all premium. All right. And Micron just had their earnings. Well, they didn't just have it, but they had their earnings on June 25th. So July, August, September. So the next earnings are going to be September 25th, roughly. I don't know if it's official yet, but oh, you guys can't see this box probably. All right. Earnings, June 25th. Thank you. Useless. All right. In 3 months later would be September 25th. So probably those short calls expire before the earnings reports. Therefore, you don't really have a danger of a major catalyst sending them higher. I mean, obviously, any day it could happen. Micron is only trading at 10 times forward earnings. It's not like they're expensive, but I don't think I would panic buy them back. I mean, it depends on your risk tolerance. I would put a stop. I'd say if Micron goes over 120, I would seriously buy back half. So I would keep a target on that. Either buy back or cover. You don't have to buy them back. It's still a stupid amount of premium. But you could either buy back or you could cover with like a 2027 110, 140 spread, something like that, just to make sure they don't completely get away from you and kill you. Because if it goes down, there won't be much loss in the 110, 140 spread, but the calls would expire worthless if they stay under 120. So you would most likely be even or happy about that. But if you've already sold them and you already have them naked and you have that kind of margin, I don't think I'd be panicking now because it's you sold the 120 calls, you didn't sell them for nothing, right? 121 short calls. Because they're not at one. Oh, I'm sorry, they are at 120. They're over 120. I apologize. They're over 120. I don't know why I'm getting that thing mixed up. So you have a 121 short call, but that's all they are. And they had a pop and they got to here and they already had their earnings, and in their earnings they actually went down. They disappointed on earnings, and as you come back to the next earnings, people are more likely to start selling them off than buying them, because last earnings were bad. Not that they were bad, they were pretty good, but not good enough to make people happy. So they, if the assumption is that they're going to have the same not good enough earnings. And does Micron have a special deal with Trump? I don't think they do. That's something that's the question you should be asking. So, and again, when I get back to chat with the bots and all, we can check it out. But does Micron have a special deal with Trump, or are they going to suffer because they don't have a special deal with Trump and other people do? That's what we've been talking about all week. the thing about an oligopoly, and this is only the beginning of a building of an oligopoly. You know, it's like, you know, oligopolies you don't just throw a switch and say, oh, we're Russia. But how did Russia become Russia? Russia is an oligopoly. What's an oligopoly? An oligopoly is a country in which the politicians and the big corporations are arm in arm on everything, and that they put hits on small companies, and if somebody invents something that pisses off another company who's a friend with the president, that company gets regulated out of business, or gets legislated away, or somebody gets some poison tea. You know, that's how, or somebody gets thrown out a window. Thrown out a window is the leading cause of death in Russia. I don't think they call it thrown, I think they call it falling. I think it's called falling out a window. You know, and who knows, maybe windows in Russia are less safe than our windows. I certainly wouldn't want to stand next to one. They don't have that little safety glass or whatever. So anyway, so they're in the money, but what did you sell them for? You sold them for some number. Let's say you sold them for $8. So they're in the money. They're probably $8 now, but they're only $4 in the money. They're not $8 in the money. So there's still a lot of premium there. You can roll them to a higher strike. You don't want to, though, because when you risk earnings, it's different, but you're not risking earnings. This is the key to what I'm telling you now. They've only got a month to go, and you're not risking earnings. You are going to get out before earnings, or in the very least, if it still goes up, you will roll into the earnings premium. But at that point, see, if it was earnings, I would say absolutely have some covers, because what the hell are you doing with no covers? But given that earnings aren't, you know, given that there's no likely big swing event coming up, you should be okay. But again, the problem with the oligopoly is you never know. Okay, so if you start seeing the CEO of Micron walking into the White House, you know, with a bulge in his pocket, and he's going to walk out without that bulge, not that kind. Oh, that's funny. Okay, stop. All right. Anyway, money. I'm talking money. I'm not doing. Sounds like sex. Where was I? So anyway, so yeah, the problem with an oligopoly, and like I said, Russia, you know, Russia took many years for this to happen. It's like, you know, Putin took over companies like Gazprom by, that was his kickbacks. He got put on the board. He gets some stock. You know, perfectly logical, right? We want President Putin to be on the board of our great, powerful company, and this way he will be over to see that we're doing things in Russia's best interest. Well, that sounds good, but the board seat comes with $1 million a year compensation package, blah blah blah, which is nothing to Trump. So you have to do better than that. But meanwhile, Putin's like much richer than Trump. Putin's got like $100 billion. That's how much money has been funneled into his pockets over the years. In fact, one of the reasons Putin started the Ukraine war was to funnel the energy that was building up against him into something that he could control. So in other words, he started the Ukraine war as a nationalist thing to take all the energy of the young men who were actually starting to you know, talk in cafes about like getting rid of Putin and overthrowing the government, because they were sick of living under this bullshit. We're not sick of it yet. We're just watching it going, what the hell? I mean, every day it's something else, but one day we'll be sick of it. So anyway, so oligopolies do not happen overnight. You have to build them brick by brick. You make a deal with this company, you make a deal with that company, you get a kickback from this one, they get a kickback from that one, the government intervenes, the courts intervene on behalf of somebody. Somebody gets, you know, you rule that Google has a monopoly because Google didn't pay you, and that's in favor of Elon Musk, and that's in favor of Mark Zuckerberg, who do pay you. You know, it's that kind of stuff. It's just years and years of that kind of stuff until the only people left are your buddies. Everybody else gets wiped out. That's what we're heading towards. The guys who sat behind Trump while he was being sworn in, that was a sign of allegiance. And one by one, they're getting favored. And not for free, they still have to keep paying, but it shows that they've got the ear. These are the guys who get to talk to Trump and get to walk in and get to hand him the checks. And he will take care of them and make sure their interests are protected. So it looked bad for Apple for a bit, and all of a sudden it's like, oh, Apple doesn't pay taxes. What are you kidding? There's no tariffs for Apple. They're exempt from everything. We don't care if they make their stuff in Vietnam. In fact, the biggest joke is what we just did with NVIDIA, right? Because NVIDIA couldn't sell their chips to China because of national security. Oh, it's a huge, huge threat. The threat of selling the world's greatest AI chips. Grave matters of national security. This is why we have to regulate it. But as soon as NVIDIA agrees to give the 15% kickback to the government for every chip sold, oh, go right ahead. Sell those same chips to China. Go sell your top of the line chips to China. Just give us 15% of what you get. The hell is that? What happened to national security? But you know, things don't have to make sense in an oligopoly because the people in charge are not Democrats. They're not, you know, they don't act like not Democrats. I mean, not Republican Democrats. They're not democratic. They don't give a shit about the courts. They don't care about what the rules are. They don't care about what seems right. Right? Like you see this gerrymandering stuff. They don't care that it's blatantly against everything that democracy stands for. That's not the point. They're gonna draw their district in circles and make squiggly lines all over the place just to make sure they rope all the Democrats into one district. You know, like you know, there's a huge amount of Democrats here, there's a huge amount of Democrats here, and a huge amount of Democrats here. So let's put all those Democrats in one district so they can only elect one person. That's what gerrymandering is. So it's not that they're trying to draw in a Republican district. It's more that they're trying to capture the Democrats all into one single small district so that they have they'll win their district, but they won't win any kind of control of the government because there's only a few. So you concentrate your enemies into one place. You push them into one place, which is how you then round up people and kill them also, right? You get them all in one place and then you put the police there and you start building walls. It's the same thing. All right, so anyway, Micron. So yeah, I would do this, but keep a huge eye on it. I would also have a conversation in chat about, you know, what we can, you know, what the situation is for those guys. Can you tell us what you like most about the healthcare sector as a whole right now? What I like about the healthcare sector as a whole is you have to buy it. You know, when you're in a recession, when you're in a declining economy, I like things that you have to buy. I like shoes. I like Crocs. I like not Nike because Nike's too expensive, frankly, but I like a place like Foot Locker, which got bought. That was my premise on Foot Locker. I'm like, people need shoes and they need cheap, you know, they need not expensive shoes, they need basic, reasonable price shoes. Foot Locker's got that. I like Crocs also, which is also cheap shoes. I like, you know, I like Hanes brand. We just bought Hanes brand, which is underwear. It's the same as healthcare, though. It's like you got to have it. There's some things you got to do no matter how little money you have, and healthcare is one of them. So here's Hanes brand we just got back into, and it popped on earnings like we thought it would. Because again, it's not complicated. It's too cheap. It's only 10 times earnings now. It was like 5 times earnings, 6 times earnings down here. It was just stupidly cheap. It's a freaking underwear company. People buy underwear. Look at the earnings. Beat. It's just a boring company no one pays attention to. We always buy them when they're down like that. So, you know, healthcare, people get old, people fall apart, they need stuff, you know, and it's very steady, good investment until the healthcare system goes bust, which we're not there yet. You know, but as long as people can afford to pay for healthcare, it's a realistic investment. So that's a good time to bring us to our bigger conversation on earnings and such. We did two things here. Well, no, let's first go over the actual investments that we've got. Let's talk about that first. So here's our portfolio review. And as you can see, our last portfolio review was, you know, July 15th-ish or something like that. Well, I could probably find out. Why isn't it? That's very odd. I wonder why that would be. It's the right color for a link, but there's no link. That works, that works. Huh. I am baffled. Anyway, so let's assume that July 14th was our last thing, which should be somewhere in the middle of the month. Anyway, so we're lower. You know, we went up in the Dow, we went down in the Dow. And the Dow is a shitty index, but it's just an example of what's going on because we're down there. So we looked at that. Oh, I'm not signed in. That's why I can't click on it because this annoying sign asking you if you're a member comes up. How much? Oh, I can't see that much without paying. Oh, that's so annoying. Bloodsuckers. All right. So anyway, so they get me every time with this. Oh, membership has its privileges. Mine brings me here because I'm an administrator. There we go. This will be much better. All right. See now, oh, look at that. So now it tells me July 15th. It tells me what I already knew. All right. So it was July 15th, the last time we did a portfolio review. The Dow went down, the S&P went up, the NASDAQ went up, the Russell is now, well, the Russell was down also, but now it's up. I honestly don't get what all that's about. Oh, here's the S&P. So here's July 14th. So the 15th, we were right there. And the S&P has gone up, not much, 4%, something like that. So we pointed this out that even though we were all the way up here, the RSI is only at 60, so we're not super duper oversold. And well, now 2 days later, I think we might be. You can always look that up. My ad blockers on, drop dead. See, here's another one I subscribe to and shouldn't be bothering me. Come on. Oh, log in. This is so annoying. All right, and your charts list. Is that what it's called? My charts list? No, it's down here, default list. That's PX with modal pop-up. Not that one. Oh, you're not going to show me. Oh, I see. Well, that's pretty awful. All right, either way. So now we're at 66, right? 70 is a danger zone. 70 is where you start getting seriously oversold. So now we're at 66. And it's math, by the way, okay? So here we were on the 12th, which is only yesterday. So yesterday we were at 60, at 63, right? And now, but that was the beginning of the day. So it's two sessions now. It's yesterday's session and today's session. So now we're at 66. So the RSI went up 10%, and we're at 64.48. Right? So if we now go back again and we say we were at 373 and now we're at 448. So 448 minus 373 is 75 points divided by 63.73, 1%. So another 1% up, another 60 points up on the S&P will push the RSI up to 72, and that's too much. So it's not likely we're going to go up more than 60 more points, which is going to be just over 64, which means 64 is going to be, and 64 is already going to be a tough nut to crack, especially as we're so far above the 50-day moving average here. So we're way above the 50, we're miles above the 200. This is not normal. And it's kind of like this. It's kind of the same situation as we had here, where there's just such a big gravity well below. See how it was up here? All right, and I bet the RSI, no, it wasn't even this high. It was not even that high then. Here's where the RSI is high, and see what happens when boop like that. You know, and it's not terrible, but it's like 3%, 4% this drop. But then we went up here, but then we had a proper drop, and we had a nice long pullback. I was like going back on that 10%, but then we went another 10% after that. And then the RSI got cheap, right? Then the RSI is showing you should be buying. Very, very clear. It's a good indicator, the relative strength indicator. And so here, too much, and what happened? We had a sell-off, and now we're here, and what do we know is going to happen? We know that 1% from now, not 1% from now, 1% from this now, not you, this now, 1% from this now, so basically 6,500 is a no-no zone. You know, there's no guarantee things can be crazy. Oh, look at this. Here we were over, and we just calmed down a tiny bit, and the thing kept going up. But why? It's because of trade deals were made, right? So we made trade deals at lower numbers than we were expecting, and then we had better inflation data. We had a worse jobs report. Let's remember why we're here. We had a worse jobs report, and that cheered everybody up. And then we had lower inflation numbers, possibly because people don't have any, consumers don't have money anymore to spend, and that caused it to go up. And now we have the rumors that the Fed is going to lower. And in fact, this morning, so you know, what do they say? This rally is brought to you by the letter H. Or in this case, the letter Scott Bessent. Bessent, Fed 1.5. There you go. Oh, no, I'm sorry. I said 1.5, 150 to 175. Oh, he's so funny. So Scott Bessent is telling the Fed he wants a 1.5 to 1.75% rate cut, even though we just had shitty auctions, which indicate that the rates are too low, that the bond buyers aren't willing to buy our bonds at the rate they're at now. We just had two terrible auctions in a row trying to sell our debt. These guys are in fantasy land. They're just basically ignoring the basic fundamentals of the system. We're borrowing money. And we by the way are borrowing insane amounts of money for the rest of the year because they've been trying to reduce supply. The same Bessent has shifted our debt, which is, oh, I cannot tell you how bad this is. To avoid selling 30 and 40, 20, I'm sorry, 10, 20, and 30-year paper at 4% interest, he is selling, he's shifting everything to the very short-term rollover notes that are trading at a couple of percent. But the problem with that is that as they turn over, when the reality of the rate environment hits, they're going to go up too. So what he's trying to do is he's trying to force it. So in other words, 6-month note rate, rat. Actually, they're 4.11. Jesus Christ. So they're insane. So they're trying to shove everything into the short-term yielding notes. And that's based on the fact that again, they don't understand how it works. They think you can just lower the rate and people will just pay whatever you say. It doesn't work like that. They just won't buy the notes. If nobody buys your debt, you're screwed. You gotta roll your debt over. And our debt is insane. And we're rolling over like $10 trillion worth of debt in the next I think 6 months. I think it's like 6 months that we're rolling over $10 trillion worth of debt. And they want to roll it all over from 10 to 30-year notes to short-term notes. And what that means, though, is if rates spike up, if something happens, like a few bad auctions, or if something happens that people lose faith in the dollar for many, many good reasons that people will lose faith in the dollar, and our rates spike up like what happened in Greece. That's what happened in Greece. The rates spiked up and it will immediately affect us. It won't be a long-term problem. It'll affect us immediately because we have all short-term paper. We don't have any locked-in long-term debt at a certain rate. So if interest rates go up to 6%, all of our notes will go up to 6% like in one cycle. That's like, I mean, that is literally like having an incredibly short fuse on a firecracker and you light it and you've got like the second you light it, you got to throw it. Otherwise it's going to blow up in your face. That's effectively our economic policy. So good luck with that. So where were we? Can't even get past the chart that introduces the post. That's not good. CPI, right? That's a fallacy because the CPI is clearly ticking up. Inflation pressures are going the wrong way. Well, they were coming down. Now they're going back up, and you want the Fed to lower rates, which will cause the CPI to go up. You're going to put tariffs on everything, 10 to 15%. Isn't that going to raise the cost of everything 10 to 15%? If you well, only imports, so there'll be so let's say we import 1/3, so it'll bring the cost up 5%, let's say, on everything, on the average. So that's got to work in. And then the Fed says, well, it's transitory, right? But what does transitory mean? Transitory inflation means, yeah, they're like, yeah, well, you'll get a one-time 5% bump in the cost of everything from these tariffs. But, and not services, right? Because services are services, they're not imported. So we won't get it on services. It's going to be on a portion of our goods. But they're saying 3,800 per household, and the average household is 100,000 bucks for income. So 3.8% is the number of inflation that you will pay for tariffs. So yeah, it'll be 3.8% over, let's say, a year. And why is it transitory? Transitory means it won't keep being 3%, right? That's true. He's not going to raise the tariffs again. Prices will adjust up to 3.8%. And when the Fed says transitory, they don't mean the inflation goes away. They mean that the next year it'll stay where it is. The prices stay where they are. So the inflation has gone away, but not the inflated prices. The inflated prices are there to stay. That's what transitory means. Transitory means we won't have another 3.8% year next year, so the inflation will go to 0%, theoretically. So the inflation goes to 0%. It's not here to stay at 3.8% permanently all the time. That's what the Fed means when they say transitory, but that's bullshit. How I mean, how does that help the American people? It's it's like saying the bullet that hits you is transitory, so you shouldn't worry about it. Somebody gets shot, and like, well, it's transitory. You're not going to get shot again. So go home and shake it off. People are nuts. So federal debt payments are currently $84 billion per month. I'm sorry, only the interest on the debt is 84 billion a month. That's just the interest on the debt we already have. And despite all of the tariff revenue that Trump is getting, we are more in debt now, and we are running a bigger deficit now than we did last year. So somehow, with his what claimed, which is not true, but his claim, let's forget what's not true. He says 600 billion is really like 300 billion, but even with $300 billion of tariff revenue, he's spending more money. We're going more into debt than we did last year without the tariff revenue. So somehow he's spending money faster than $300 billion a year extra. And again, this is why we're borrowers. Every month we're turning these foreign countries and borrowing money. They are going to at some point say to us, you look like a credit risk. You look dangerous. So small businesses, not all businesses, just small businesses are paying $202 billion across 236,000 companies. And by the way, when they talk about small businesses, I don't think they're not talking about every small business either. They're talking about certain level of small business. They're not talking about like accountants and lawyers and this and that. But anyway, it's about $1 million each that small businesses have to pay. And small businesses, again, oligopoly. Small businesses aren't the guys who get to knock on the White House door and say, here, Mr. Trump, here's $30,000, don't tariff us. That doesn't work. Doesn't even work if they're in Mar-a-Lago. They're not big enough to matter, so they get crushed. And obviously, if big businesses want to take over and get bigger, they have to crush these small businesses. That's why we're shifting the burden of taxes onto the small businesses. Eventually, it just becomes unprofitable to have a small business. People give up and they go to work for the giant corporations. Consumer inflation from new tariffs. So you're creating a system that grinds down the individual. It's what Anya calls the clamp down. That's her. That's her observation of this. This is a clamp down. There's a Clash song called "Working for the Clamp Down," and that's what she calls all of this. It's the clamp down, the oligopoly grinding down, the state taking away your rights and taking away your freedoms, and so on and so forth. it's not, you know, because we look back at history and we look at like Hitler taking over Germany and as if it's like some sudden thing, but it wasn't sudden. They took power in the early 30s, and it wasn't until like 5 years later when these things were going into place. You know, what Trump's doing is much faster, much faster than what Hitler did. He's rewriting the Constitution. Hitler didn't do that until many years into his thing. Trump is rewriting the Constitution. He's packing the courts. He's just taking down the press, so on and so forth. This is what you do if you want to take over a country. But the speed he's doing it and the lack of resistance is just incredible. I mean, just the people are just sitting here being like, yeah, sure, go ahead. Free press. Oh, who cares about the free press? Who cares if we can vote? You know, who cares if we have vote counts? Who cares if Elon Musk pays people to vote a certain way and stands on the street handing out money for votes? So a bunch of, I mean, what are you doing? You want poor people to vote in the interest of a rich person without having any care of whether the policy is good or not, right? And I don't know. I mean, I guess if the rich person is one of yours, then great. But it's so not America, or it didn't used to be anyway. So inflation from tariffs, obviously we talked about that. Corporate earnings growth is down, and and again, the point we were making today, if you take out the Magnificent Seven, it's terrible. Corporate earnings without the Magnificent Seven are generally awful. You know, and we're switching currencies. We're switching to Bitcoin as a currency. All the banks are moving in this direction to go and start having Bitcoin reserves and so on and so forth. They want your 401k to hold Bitcoin. Why do they want your 401k to hold Bitcoin? Because 401ks are, you know, 20 trillion something dollars in America, and so if 10% of it was in Bitcoin, that would be $2 trillion worth of Bitcoin. You know how many Bitcoins there are in the world? 2 trillion. Imagine what they'd be worth if everybody had Bitcoin in their retirement account. And if 10% of your retirement account was in Bitcoin, then all the retirement accounts would be full of Bitcoin, which would mean if somebody wants a Bitcoin, they would have to pay $100,000 something dollars. But I guess that's good, because if you have the Bitcoin in your retirement account and it's worth $100,000, it would seem like you're rich. But that's only because it's sitting in a stagnant retirement account and not circulating. And so the ones that do circulate would be the ones that gain the value. It would on paper look like yours had the value, but you know, if everybody cashed out and tried to sell it, all of a sudden it wouldn't be worth quite as much. It's crazy. And there is nothing worse, by the way, in a retirement account than thinking you're richer than you are. That's the most dangerous thing there is. What else is going on? So here's the monthly chart. So that's what's happened in the month since our last portfolio review. And here is the money talk portfolio. And we have a T. We're waiting to collect the rest of that. Lockheed Martin was terrible. Where is Lockheed Martin? Oh, it's below. That's what happened to Lockheed Martin on their earnings. And it's not a big deal. It really, it went down 10%. It's like, if your position can't handle 10%, then you're in trouble. We still have a 628% upside potential from this thing. I can't, I highlighted this. I can't make this move. I said, why isn't that blue? I can't do that. If I could do it, I would. But in this portfolio, we can only make adjustments on the show. So we couldn't make this adjustment. But if I could make the adjustment, there's an adjustment to be made here and take advantage. Applied Materials doing great. It's going to make 20,000 bucks for us. ARC B, we said we actually dropped our downside, and we say it's $10,000 upside potential now. This basically, I'm saying this should hold, and we should get back to 80. That's what our spread is there. You know, and remember that, you know, when you see when you see the portfolio and we took a $30,000 hit on the money toward portfolio, we're still at 75% for the year. And in fact, frankly, yesterday was a bad day. Let me show you something. Let's take a look. So yesterday, this portfolio was, whoop, don't even know. Let's find the bottom of it. Now remember, there's a money toward portfolio. We couldn't change it. It was at 178,000. It was up 78.5%. It started just about, I think it was August 20 something. So it's just about exactly a year old. And so today, with not a single thing being changed, if I can find it. I'm making a big assumption here that I know what I'm talking about, but we'll see. Could be embarrassingly wrong. No. Because when I was doing the numbers, I noticed that we were getting particularly terrible valuations, and the VIX went lower today. And as I expected, we have tighter ranges. So the tighter ranges are fixing our portfolio. So this was just a bullshit number, basically. When we thought it was at 78 or whatever it is. Yeah, 178 was just a bad batch of very poor valuations that we got here that were not normal, and because the VIX went lower and because there was a couple of good volume days, more things traded, and since they traded and they aren't old prices, the new prices are showing that our stuff is in fact worth a lot more. It's 207 now, from what, 178. Yeah, so we actually basically got our $30,000 back in one day. But that's exactly what I was saying when we were going over the portfolio. I'm like, this is a bargain, this is a bargain, and this is a bargain. Foot Locker has 2,800 left to gain, even though it's already being bought, so it's kind of a dead issue. Invesco, 14,000, 202% from the position, 14,000 of upside potential on Invesco. Nokia, 161% upside potential. Ozark, and you see here I put great for a new trade. I tell people all the time to look for things, and like look in our portfolios for bargains that you could buy right now. I say it all the time, but when I remember, I write great for a new trade, because like, holy shit, this trade is just such an easy way to make 218%. It's like amazing. This one, oh, Pfizer, could this be the perfect trade? It's an $815 credit on a $14,000 spread. So it has 1,800% upside potential on Pfizer at a bargain price. So we don't even pay for the spread. We take the spread. There's margin, of course, but we take the spread. We get an $815 credit, and if it works out, we make $14,000 more dollars. And I'll show you what that spread looks like. There's nothing crazy going on here. We have 20 long $20 calls that are $450 in the money. So this is $9,000 in the money. We sell 15 of the 27 calls. So we have a 20-27 spread that is more than half in the money, right? We sold some puts, the $32 puts. Those were a bit high, but we have a lot of faith that Pfizer is going to come back and be that high again. We also sold some October puts. And again, it's the money to our portfolio. I can't adjust it. I would adjust it if I could. I would sell some short calls, but I can't. So we have these October 26 puts. We're at 24.50. I'm not worried about them. So these are going to be fine. The dangerous puts are the December 26 puts, but those are a year away. And I expect to be back to 32. So I'm not really worried about those either. So it's, and we can always roll them or change them. It's no big deal. So that's what the nature of this trade is. That's why we have a credit, is because of these puts being so far in the money. But we originally sold them for 6 and they're only 8 now. It's not like we didn't, we sold them knowing they were high out of the money. But the net of it is it's an $800 credit on the spread, and it's a $14,000 spread if we get to 27. And we expect to go to 32. So it's fantastic for a new trade, obviously. And that's the kind of stuff we do. There's Ozark, there's Pfizer, here's Schlumberger, which has $8,000 upside potential. Signature has, we already made a shit ton of money on Signature. We're up 160% already, and we have 400 more percent on, in other words, counting that we're now at 13,000 something, right? So we started out at 5,000. Now we're at 13,000 with that much gain, $8,500 gain, which is 160% gain. But from 13,000, we still have 60,000 left to gain, which is 439% more. And look how nicely Signature's behaving. And what do we need Signature to do? Let's take a look at that. How crazy is our hopes on Signature? Well, here's Signature. What did we do? Our main spread is a 65 spread. All right, that's our target, is 65. We sold some 55 puts. It's at $69. We sold some $80 calls, and we're at $69. So those are in good shape. And we sold some $70 calls as well. Didn't I sell any puts? I feel like one of these should be puts. Anyway, well, we'll find out. I'll check it out. But either way, it doesn't matter. If it were puts, we'd be making money. If it's calls, we're making money. It's all good. Everything is good about this. And again, this is a portfolio we're not even allowed to adjust. If I was allowed to adjust it, we'd be doing way better. But we don't touch it unless we're on the show. And 2 more months till next time. Here's Target, great for a new trade, obviously. I'm sure that's worth looking at. And again, oh, please. Look at this. This is a gorgeous channel. This is a deep value channel. It's going to just keep climbing and keep going higher. 429% upside potential with a 20,000 more conservative target. Oh, I get it. I'm like, hey, that's funny. Here's Whirlpool, also great for a new trade. Ridiculously low price on Whirlpool. They got caught up in the tariff bullshit, but they will recover. And here's good old Exxon, great for a new trade with 3,000. What? Because it's a net. Oh, actually, it's a net 600 credit. It's accidental when you have this kind of number, because it's like, this turns out that the credit is small. If the credit was a $10,000 credit, this number would be much lower. But it's a $600 credit, and we make $20,000, so it becomes 20,613 divided by 600 is 3,000 blah 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 percent. But anyway, it's Exxon, okay? They're gonna make money. Don't worry about them. So then we did this, and I said, here are the gains, and I could not emphasize this enough. These 6 trades that I said were good for a new trade have $185,000 of upside potential. The rest of the portfolio has 200, or the total portfolio is 296,000, 166% of upside potential. And that's why we bounced $30,000 in a day, because look at that upside potential. $30,000 in a day is nothing. All we need is a couple of good days, and we're going to make a huge chunk of that upside potential. And what we got yesterday, and I didn't mention it yesterday because I was like, I don't care. I don't care. When you're up 78.5% and you should be up 100%, what am I going to do? Sit there and complain? I look like an idiot, right? So I didn't say anything yesterday. Now I bounced back though. Because I'm like, what am I going to sit here and complain and whine because I'm up 78% for the year? But I knew it was unfair. 700 a month portfolio, different kind of trades, was up 131%, and today it's up This is what happens with options. That's one thing you got to get used to, is they're going to reprice themselves, and you need to learn to sell at the correct time, not just when you panic. 133. So that's pretty steady. It was just a weird thing about the stocks in the money portfolio. They just had a weird day yesterday, and that just happened to be the day we did the report. And the short-term portfolio is up 10%, which is fantastic because this is our hedges. The job of the short-term portfolio is to protect the long-term portfolio. So we have a short play on SPY, we have a long play on SQQ, which is an inverse ETF, and they're like insurance. But what we do is we take our insurance plays and we sell short puts and calls against them or whatever, and we bring in an income. So over time, the insurance plays pay for themselves, and then we end up with free insurance. So it's only that first time that we have to put the money in, and after that, the insurance is free, and that's why the short-term portfolio turns into a massive money machine over time, because once we pay off our original insurance, what does paying off our original insurance mean? It means we get all the money back. It means the money we laid out for our insurance comes back to us over time. Therefore, it becomes a profit in the portfolio, and we still have the insurance. And then once in a while, the market dips, we cash in our insurance policy, and then we have a shit ton of money. You don't tend to go more than a couple of years before like the market takes a dip and you have an opportunity to cash in your insurance policies. And then what do? Well, since these are very bearish positions, we are free to take some bullish gambles. Bullish gambles like, well, this didn't work. This one didn't work. I said to cash it out yesterday, but we bought some Schlumberger calls into earnings. Didn't work. Lost $1,000. These short puts, though, are all working. We're already up 8, 10, let's call that 11, 12 and a half, 13 and a half, 14, 15. So we're at $15,500 in not very long, because we only just started this portfolio. So it's from June. In 2 months, we're up $15,000 on short put selling. And more today, I guarantee you, because obviously everything's going up. Then we take a long play on Gilead. And the reason it goes in the short-term portfolio is because we expect that we'll have to make a lot of adjustments, or that they'll take a lot of effort. SRPT was a home run. That came out very well for us. But those are our hedges. And actually, this hedge is, I want to say 80,000, and this one is $90,000. So we have 80,000 in protection here and 90,000 there. Not against this portfolio. This portfolio doesn't lose money if it goes down. It's for the long-term portfolio. So in our $500,000 long-term portfolio, which is only 20% invested, we've got $170,000 worth of coverage. And we're also covering the other portfolios, but in other words, this is cash that we have ready. If the market drops, this thing will jump $170,000, and we've got all that money to spend on other stuff. So Gilead, SPY is still good for a new trade. SQQ, $90,000 worth of downside protection. SRPT is fun. We said we're having too much fun to cover, so we're going to hold that like it is. And there you go. That's all you need to know about our portfolios. Swamp Fox says, I thought we had JPM in our Money 12 portfolio. I hope we do. If you remember when, please let me know during in member chat, okay? Because I would love to. If I forgot to add it, I would love to have it. Does sound like something I would have, but I didn't log it somewhere. But if it was said on the show, then it should be in the portfolio. End of story. I wonder why wouldn't I? I don't know. I do not know. All right, so there it is. So back to our main stuff. Oh, how nice not to have any like Fed or anything to talk about. We can just talk about the important things. Well, I'm not going to do both of these. All right, no, I will. Sorry, they're kind of related. So here's what we're looking at in August. And look, I know I am a bleeding heart liberal. I am a Democrat. I am not fond of the president or his policies, but it's honestly not because I just knee-jerk don't like anything a Republican does. It's because I think that what Trump is doing is incredibly bad for America. So yeah, I have to check myself when I'm talking about these things. And it's good that I have these AIs, because I say to the AIs, and you might think like, oh well, the AIs talk to you all the time, so they just want to kiss your ass, blah blah blah. I really teach them not to do that. I mean, what the hell good is it for me to have AIs analyzing the market if all they're going to do is say the same thing I would have said? There's no help there. I need other opinions, so I teach them to be contrarian and to look for other things. But sometimes I say, am I crazy? And so I ask Warren to write an article and to say, Warren, you look at the markets and you tell me what you see. I'm like, you tell us what the strategy note is from you for August and going forward for the rest of the year. And so he writes it up. And he talks about what went on during the week, and there was week, and so, because I'm thinking like I'm being too nervous, I'm being too worried, because I think all these policies are going to lead to a complete disaster. I believe that, but I can't let that be my influence. I got to be careful that I'm not seeing things through whatever the opposite of rose-colored glasses is. So I'm trying to be, what does Fox say? I forget what they say now. Whatever. Not re-report, you decide, but whatever just the facts, basically. I'm just trying to stick to the facts and make sure we got a thing. So I let Warren write this report, and he says the tariff regime went live on August 1st. And again, this is very important, because sometimes you got to think in perspective. It's like, yeah, we only put the tariffs on really on August 1st, and it's August 15th, and we're looking at the CPI report from June and July data, June data and July data, and we're acting like that somehow matters, when we absolutely just changed the whole underlying premise. And it won't all roll in the next report either. We won't see the full impact for a month or two. So when you look at these reports and the market goes up, 1.5%, 2% based on a report that has nothing to do with the new situation, you just got to think about it, like, what are these people doing? All right, so he's just pointing out facts. Liquidity, the long end is shaky. The 30-year auction was terrible, the worst since 2024. The 10s were soft. There was a single large sell program that knocked the yields out. Treasury is holding coupon sizes steady, but doubling their buyback. So in other words, Treasury is bailing out the auction. Scott Bessent, remember him? That's the guy. He's faking the auctions so they don't look as big of a disaster as they are, and they still look like a disaster. They're faking the data. You see, I sound like a hater. That's the problem. It's like, how do I criticize the administration without sounding like a hater? And even I see even the Michael Bolton, Joe Rogan, all these pundits on TV, you know, one by one they're turning and saying bad things, and all of a sudden they're immediately like ousted, like, oh, you said something anti-Trump, you're not a whatever, you're not a MAGA, go away. We don't like you anymore. We don't listen to you anymore, even though we listened to you for like the last 8 years. Now we're not going to listen to you because you said something bad about Trump. God knows what happens to me if I say something bad about Trump. I've never said much good about him. And again, not because, I don't know. What am I going to say? I'm a New Yorker. Everybody, not only am I a New Yorker, I'm a New Yorker who used to consult for all these different businesses, and I ran across Trump many, many times over the years. I'm not going to say anything. He is everything you heard about that's bad is true. and this is why he went to Florida. He didn't go to Florida, you know, he didn't go to Florida because it's sunny. Does that mean he doesn't have a real tan? That guy doesn't spend time in the sun. He likes to golf. He's got golf courses up north. He left New York because New York said, go away, you son of a bitch. He is reviled in New York. There's nowhere he can go where he isn't just basically hated. And not because of his presidential crap, but because of all the horrible things he did before he was president. So you know, he was already an outcast, and this is why this whole thing is like a revenge thing with him, because you know, he burned all his bridges long ago. And again, that's not why I hate him as a president. I hate him as a president because of his policies, because of what he's doing. So we'll see. Maybe I'm wrong. And again, this is why I gotta turn to my AIs once in a while and say, maybe I'm wrong. Go ahead, give them your fairest possible evaluation. So what is it? Well, Q2 growth are looking good, 80% beats, but the breadth is all mega caps. And the Fed, after a weak July print and higher jobless rates, markets are now pricing in 90% chance of a September cut. And now they're spinning that, Bessent is spinning that and saying, oh, cut. No, not just a cut, a super cut, a not 0.25, but 1.75 is going to get cut. It's completely unrealistic. But you know what also though? The reality is Trump just made a new appointment to the Federal Reserve Board. Powell is out in May of next year. So Trump is putting in his guys, and they'll get their super cut, whether it's good or bad for the country, whether it's a smart move or whether it's going to destroy America. They're going to get their cut, because these are not guys who do the math. These are not guys who wait and see, and these are not guys who are happy with small measures and wait and see what happens. These guys want their cut now. So we have we have the Jackson Hole meeting that needs to be paid attention to. We have the CPI coming up. We just did the CPI, sorry. And then the other inflation reports will be coming in. The VIX is calm but not complacent. I mean, this is really great notes on everything that's going on. Accountability, July calls versus reality. What did we get right and wrong? I asked him that. I said, make sure we're held accountable. So we said tariffs would bite and become a daily headline, and obviously they did. We said the auction premium risk is at the long end, and that's happening. We're having failed auctions. We said the valuations are stretched, and that's happening also. We said the VIX won't stay low, and it's come back up. What were we wrong about? The timing of the drawdown. We expected the markets to realize, we expected the markets to see what we were right about and react in a way that says, you know, we should be more cautious here. It's not happening at all. Not at all. So we're wrong about the reaction, and how long will we be wrong? That's the question. So what are the realities shaping August? Tariffs are policy now. Import volumes are rolling over. officials are leaning into tariffs as a revenue line of 50 billion a month is being floated. And he says if that's sustained, that's a meaningful fiscal offset. But will it? But is it real? Is that really what's going to come in? We're nowhere near it now. We're not even at 30 billion now. So will that actually show up? And again, you can't tell in a month or even 3 months. You have to wait and see what the patterns are because people change their behavior. You know, let's say it's Tide Pods, right? Let's say Tide Pods are made in a country that comes in with a 30% tariff, and therefore Tide Pods go up 30%. But then other things don't go up 30%. All of a sudden, Tide Pods are not a thing. People won't buy them anymore. They don't perceive enough of a difference in a Tide Pod versus a Solo Pods or whatever. I don't know if that's who doesn't go to the grocery store? Me. I'm like, well, or whatever. I mean, I do go to the grocery store, but I don't buy Tide Pods. So anyway, so maybe I should have picked something I know something about. But point being that certain things, for whatever reasons, may end up failing in consumer demand. And you won't know until consumers have a chance to go a couple of rounds at the grocery store and do a little shopping and do some comparisons and talk online and decide that this is no longer an affordable thing. This is an affordable thing. This is what we do now. Entire activities come and go based on consumer trends. Things that you used to do that you don't do anymore, like bowling, stuff like that. Like people was like, oh, everybody bowls, bowling's forever. It's like, it's kind of like barely a thing anymore. You don't know how people are going to react or what the economic reality is until you give it some time. The bond market is not fine. And again, well, I'm not going to go over it every time, but boom, 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 very bad, very bad. Treasury's playbook: lean into T-bills, expand the buybacks. It's all said already. The repo market is getting there. There's just so much turnover that they can't keep a lid on this. There's no way to hide what's happening. Earnings beat, but the breadth did not. So it's all the Magnificent Seven. All this money. These Magnificent Seven companies are growing earnings. They're $4 trillion companies that make $400 billion. The entire rest of the S&P doesn't make $400 billion. So, when they make 10% more, then the S&P goes up 10% because the whole frickin' rest of the S&P can't lose money enough to make up for what they're making. So of course it looks good. It looks good when the oligarchs wipe out their competition because they make incredible amounts of money. They make more money than their competition was making because they're more efficient, they're bigger. They pay their employees less. See, this is the thing. How do they make more money? They pay their suppliers less. They pay their employees less. They pay less benefits. They provide less value for the money than the smaller competitors were providing, which means your life is shittier, which means the things you buy go down in quality and you settle for less stuff and you have less Cheetos in your bag of Cheetos than you used to have. Why? Because all of Cheetos' competitors are out of business. So they're going to give you less Cheetos for your money and they're going to make more money. Their competitors' entire business model was to give you a better value bag of cheesy thingies, cheesy poofs, right? To give you cheesy poofs. And so their whole point of being in business was to give you a better tasting, better value, more natural, organic, blah, blah, blah bag of cheesy poofs than Cheetos did. And they clearly had a demarked competitor. Now, they still had very little market share compared to Cheetos because Cheetos markets better and has a cool tiger and all kinds of other things that they market themselves. So they still got the most of the market, but at least Cheesy Poofs had their little niche, right? But then Cheetos gives Donald Trump probably some whatever he puts on his skin is probably Cheetos. So they give him some skin cream that's Cheeto color, and suddenly Cheetos is promoted and favored in Washington, and they drive Cheesy Poofs out of business, right? So now Cheetos has the Cheesy Poofs crowd because there's nowhere else to go, and you got to get something cheesy in your mouth. And you no longer have the option of having a bag, a heavier bag of more natural, better tasting Cheesy Poofs. You're just going to have to settle for Cheetos to get that fix. That's what an oligarchy is. You get screwed. You're paying more money for less chips to Cheetos, and you're getting a product that's not as good as the thing you used to like, but the thing you used to like is gone. You have no longer have a choice. You will buy what the state tells you to buy, and ultimately, it's Russia. This is how Russia got started. Russia used to have brands, and they used to have choices, but it all gets pushed out until basically you're eating the state bread and the state vodka and the state this. Everything is coming one brand for this, one officially sanctioned thing that you're going to have, and you're going to pay what they want you to pay, and they're going to make it the way they want to make it, without, by the way, an FDA to oversee them anymore, or an EPA. So the Fed is boxed in until it isn't. Tariffs are near-term inflationary. Headlines: price get up. Blah blah blah. Volatility is cheap enough given the calendar. And here are the scenarios for the next 8 weeks. And he gives the probabilities of what he expects to happen. So tariffs in effect, 10 to 50%. The EPS should go up 10%, blah, blah, blah. He's talking about his certainties, probabilities, severity if triggered, and what's happening. So it's the tariff regime is already live, so that's happened. The long end auction weakness is bad. The mega cap concentration, the Fed path of uncertainty and volatility. And then he's talking about chop and drift, 50% chance of this being the economy going forward. CPI is not so bad. Jackson Hole is cautious. September cuts 25%. Tariffs remain noisy but manageable. Indexes churn. Here's tariff and auction shock. CPI is firm. We didn't really have that. Another shift long. Well, it is firm actually. I'm sorry. CPI was firm. Another soft long auction. All right, so it becomes a trend. Yields jump higher. ERP pinches, fast 5 to 8% equity drawdown. So basically, this is the track we're on at the moment. Except everybody thinks the Fed is going to lower. Goldilocks, CPI soft. It was not soft. Jackson Hole leans dovish. That would be weird also. Tariffs partially diluted in the corridors, which we don't have really. And a re-rating extends. None of that's really happening. We're really here right now. This is where we are. So what should we do? And he's saying carry the umbrella, do index protection. It's basically what we're doing, frankly. And we got to start watching out for these things that are happening. All right, so that's all that report. And that report was by Warren. And today, since I wrote the portfolio review, and again, I'm struggling with this. I wrote the portfolio review, and I said to Bodie today, I said you review my portfolio review. So I'm like, you take a look and you tell me, am I being too cautious? And he says, yes, you are being too cautious. That's what he said. He said, you're being too cautious because you've got plenty of protection, you've got plenty of cash, and you should go from 20% invested to 30% invested. So we're like 80% cash right now. He says, take 10% of your cash and put it out there because he's effectively saying FOMO. He's saying fear of missing out. He's saying if the market keeps going, you are falling too far behind by not participating. You're not ready for a better market. And so that's his advice. So I need to go out there and I need to find I need to find 10% is $20,000. I need to spend about $20,000 of long-term portfolio money to improve our positions and get more positions. So this is Bodie's report. All right, here, that's Bodie. So Magnificent Seven, still the whole show. And he talks about the different companies. NVIDIA, here's how much they're up for the year. As of this morning, they're all up today, I think. So NVIDIA, Microsoft, cloud and AI dominance, Meta, advertising resilience and AI investing is starting to pay off. Google, cloud, 32% growth. It worries me that there's all this anti-competitive stuff and they don't seem to be in Trump's favor. Otherwise, I would have bought them a while ago. But they're muddling through. Amazon, 22.5. Strong retail, web services are lagging a bit, but their growth is still fantastic. They're lagging incredible growth by having, really, really good growth instead. Apple really left behind, right? Although they've now got all their waivers, tariff concerns and China exposure for them. And Tesla, of course, is minus 14%. EV demand cratering, Musk is distracted, so on and so forth. We know that story. So 5 of the 7 are positive. He's saying this is all evidence of what we're talking about, how you've got Apple's a tariff victim and Tesla is just an outright disaster from all this, and it's the changing policies. So 2 of the 5 Magnificent 7 have gone off the rails from policy changes. If the policy changes hit these guys, they could also go off the rails. And again, Trump could at any moment just decide to have the Justice Department do a big investigation into any of these guys just because they piss him off somehow. That's why I'm scared to invest in Disney. Disney has got a high, anybody who owns a network has a high probability of pissing Trump off, like one of their guys. And he obviously takes it personally. Like, somebody insults him on late night TV and he suddenly wants a whole network shut down. So we'll see. This is market cap. So the Magnificent 7 have a market cap of, is that a percentage? I'm sorry. Remember when Yordini? Oh, it'd be nice if I knew what that was. Yordini, Magnificent 7 as edited cap. Okay, so it's a market cap. So the S&P's total market cap is $55 trillion. Of that $55 trillion, this is like 46, 45. So let's say 46. So $9 trillion. That doesn't mean that's not enough. Oh, it's 30 something. That's why it's 36. It's not 46. As I was going to say, it doesn't make any sense. So 36 to 55 is 19. There you go. That makes sense. So $19 trillion is the Magnificent 7. So 19 out of 36 is 1/3, right? So 19, it's 19 divided by 50, 55. That's a percentage. 34%. So 1/3 of the S&P 500, which you can see on that anyway. 1/3 of the S&P 500 is 7 stocks. It really, and it's not just that. It's like I said before, they're the most profitable 7 stocks. Also, they're not. It goes hand in hand. That's why they're so expensive, because they're the most profitable. But it's a weird thing. I mean, if you think about it, because they're making all the freaking money. they are making all the money. It's all flowing to them. That means it's flowing away from these guys. If they're making more, here's the thing. If they're making more and the other guys are making the same, where did the more come from? If the GDP didn't grow, GDP is not growing. Very, very small GDP growth. So 3% at best GDP growth. So if our GDP growth, which is, I'll say 30 trillion. Let's say 30 trillion. So if our GDP growth is 30 trillion and it grows by 3%, that's $1 trillion, right? So if our GDP grows $1 trillion and the market's up 10%, which is $5 trillion, where did that money come from? It didn't. It didn't. It's just speculation. It's speculation that eventually the money will show up. And that's where you get inflated PE ratios and these ridiculous market caps, and you have all this deficit spending, and you have all this M&A stuff that's based on stock swaps, because there's no money. There isn't that much money in the world, but there is that much stock in the world. And people can take their inflated, overvalued stock and use it to buy a competitor, which then makes you think the competitor is worth more money, but they're not. Like the Paramount Skydance deal. Oh yeah, what was that one? Is P-Sky? Where is that? Why would you name it P-Sky? That's just awful. So look at this. I guess they shook out the suckers. I think this was just to get rid of all the poor people and everybody who got rid of their Paramount shares, because it was going down and down and down. And now it's all the way up to where it was promised, you know, a $15 buyout where it was promised. So I think they're just trying to get these people to liquidate and take a huge hit. We got out here. We got out before because it got 1250 was our target. So when it got up to 13, we cashed everything out. Because that was good. That was fine for us, and we didn't want to risk. We didn't want to risk this. This is exactly what happened. We would have been very pissed. So we took 13 and ran. This is just weird. All of a sudden, especially it hit 17 today. Holy crap. But again, this is what you get. You get just manipulated scams. Nobody's going to investigate it. Nobody's going to find out what happened. Nobody's going to check to see who made money here. It doesn't matter. None of it matters. All right, there we go. So the AI bonanza versus everyone else. Winners, communication services up 48%, led by Warner Brothers, and now being led by P-Sky, who suddenly jumped up. Information technology, 21%. They had earnings and revenue growth for information technology, so that's a good place to be. Financials, great growth, but that's from higher rates for now, not necessarily going to stay higher rates. The losers, energy, huge collapse from 80 to 62.73 this morning. And today's inventory report wasn't that good. Consumer discretionary, also not doing very well. And that's with Amazon, which is doing fantastic. So without Amazon, this is a total disaster, really. Materials is struggling also, and there's tariff issues there. So you're saying the tale of two Americas. CEOs are painting a picture of bifurcated consumers and the cracks are widening. Here's what the CEOs are saying. UBS is saying half of all spending is now driven by the top. No, that's another thing, right? Yeah, I should have mentioned that. Look, we are the investing class. We have money. We things are pretty good. And again, this is why I sound like such a liberal, because I'm talking to people who have money And you guys are all like, what are you talking about? Where is this bad economy? This bad economy is the bottom 80%. But we're in the top 10%. Most of us are in the top 1%, frankly. And we don't really talk to a lot of people in the bottom 80%. Even our maids are doing pretty well because we're paying them a lot for a maid. Like if you're a maid in the regular part of town, you ain't making this kind of money. If you're a maid at the Motel 6 downtown, you're not getting paid $50,000 a year to clean it, to be a maid. You know, so you know, we have better servants basically than everybody else, and we think everybody's fine, and they're not going to tell us they're not fine. They don't generally sit there and talk to you about all their struggles and things like that. Everybody likes to think they're so, you know, normal, but you're not normal. I'm not normal. I don't know. You know why I don't know what a Tide Pod costs? Because I don't do laundry. We've got no freaking clue what a Tide Pod costs. So, you know, I go to the grocery store. I don't buy Tide Pods. Somebody else buys Tide Pods and does the laundry. I have no clue what happens. I don't, but I do know we have Tide Pods in the house. I don't know where they come from, and I don't know what they're priced. You know, so everything seems fine in our bubble, but it's not. It really isn't. When you step out and you go talk to regular people who are, you know, they can't pay, you know, people who have to sit there at the grocery store and decide between one thing or the other. I don't decide between one thing or the other. It's like, you know, if I want something, you know, I don't look at the prices. I go down the aisle and I reach out and I go, oh, I want that, and I put it in the bag, and I take it out, put it in the bag. All right. Sometimes I get to the checkout counter and they say $300, and I'm like, for what? You know. But you know, it's a whole different thing. I see, you know, and meanwhile I'm in Whole Foods, so who the hell am I seeing who doesn't have money in Whole Foods? It's not the same for most of America. Most of America is choosing between whether to pay this bill or that, or whether to eat this thing or that, or whether the kids should get shoes today, you know, this for back to school, whether the kids are going to get shoes or whether they should get a backpack, and you can't get both. That's what's happening for most people. And so retail CEOs are saying they're front loading purchases ahead of the tariff. So people there's an illusion of people buying because a lot of people are trying to buy things that they know are going to get more expensive. Credit card companies are seeing rising delinquency rates, and this is super concerning. These are quarters, so from 2023, 8%, 50% more. 50% rise in credit card delinquencies, and the rates have gone out of control, and they've been deregulated so that they can charge higher and higher rates. So this is misleading because, you know, if the rates were maximum 18% here and now they're 30%, this is twice as bad as it looks. You shouldn't just look at the percentage of late payments. You should look at the total amount of late money and the interest rates that are accrued on that late money. That's the kind of statistic you need to have. But again, that's the kind of stuff the Bureau of Labor Statistics is supposed to be gathering. We don't have a Bureau of Labor Statistics anymore. And look at student loans, same thing, right? It's not about the percentage of late loans. It's about how much are these loans, and these loans have gone up and up and up and up. 2003. I mean, when my kids were born, 2000, 2002, when my kids were born and we were budgeting for college, we were like, well, I guess we're going to need, let's say we'll need 100,000 a year. That was what not 100,000, let's say we were saying, let's say we need 50,000 a year for college. That's what we were figuring on. And I said, let's make sure we have more than that, just in case they go to Harvard or something like that. I was like, all right, maybe they'll go somewhere good. So now, so by the time they got to college in 18 here, it was both of my kids paid $75,000 per semester for school. That's freaking awful. And if I didn't have the money, they would have gone into debt. You know, we did, fortunately, we had 529 plans for the kids, so we had the money put aside already. But if I didn't have the money, they would have paid off, they'd be coming out of debt, $250,000, $300,000 in debt. How would you like to start your life out that way? That's what's happening to all these people. And, you know, Biden was trying to stave off this tragedy, and he did. And for an entire 2 years, he got these things under control. And yes, it was costing the government money, and we were paying and subsidizing student loans, but that was putting money in their pocket, and it was a stimulus, right? And it was good for the economy. Trump is taking that away 100%. And these are now 10% of the people are delinquent. They are more in debt than ever, much, much, much more in debt than back here. And they are also paying the highest rate of interest ever. And also subject to horrifying penalties if they don't pay. That's a new thing now. So these two things together are gigantic. They're as bad as things were in the crash of 2008. That's the only thing you're going to be able to compare this to. And this is parabolic. This is not stopping. This is going up and up. This is going to get worse and worse, because just imagine coming out of school, $250,000 in debt. And especially if you had just gone to school for 4 years to be a programmer, and now they're telling you that, no, we don't hire programmers anymore, we have AIs. Or if we do hire you, we're going to pay you shit to watch the AI. That's going to be your job. We don't need you to program, we just need you to check the AI's work. That's happening to, don't forget, programming was what they told everybody to go into. For years, they said, more programmers, we need more programmers, open up more programming, put kids into programming school, fast track them into programming. So for years, at least since, let's see, because Jackie was 18, 20, so in 2019, so about 2018, since 2018, kids have been told to get their degrees in computer science and programming and so on and so forth. So we had a huge block of people going into that training, and now that they're just coming out of school, we're telling them, oh no, we don't need programmers. We need farm laborers because we chased all the immigrants out. So now we need you to pick avocados. You should have gone to college for that. That is a catastrophe. So consumer sentiment is at recessionary levels, also as bad as it was in 2008. Credit card delinquencies are at disaster, and retail traffic is down for big ticket items. And again, this is a push through for the tariffs. Here's more on the student loan stuff. $1.7 trillion of debt. 10% of it, $170 billion of that money is already delinquent. So if $170 billion is delinquent, that's $170 billion less that either the banks are earning or the students have to spend. But one or the other, it's coming out of one place or the other. And it went up so fast that it hasn't even hit the books yet. That's Q1 to Q2. So this $170 billion hit on the banks who are going to have to write off these delinquent loans, and the states actually hits both ends, because the banks have to start writing off these delinquent loans at the same time as the students are defaulting, and they're getting their credit score knocked down, which means that they can't buy houses, they can't buy cars, blah, blah, blah. It's a freaking gigantic disaster, and Biden was trying to address it, and Trump just tore it up and threw it out the window. And it's not going to end well. And this is only 10% of all household debt, which is now $18.2 trillion. How many Americans was this? Everybody's like, that was another weird thing. And again, because we are the investing class, we pay off our student loans, we have money. So it's just you know, we look at a student loan payment and we're like, well, okay, I guess I you know, it's like, oh, I got that student loan payment to pay off my kids or whatever, and I guess I won't buy that extra ski house. You know, I'm not, or I'll spend one less weekend at the shore, which has cost, you know, my annual $2,000, $3,000, $4,000 vacation. And that takes care of that. 45 million people don't have that. It's another bill that they can't afford, that they pay as little as possible on every month, and it never goes down. In fact, you hear these horror stories. John Oliver did a good thing on it. You hear these horror stories that never goes down. People have been paying their student loans for 15 years, and it's higher now than it was when they started, because the programs don't even have a logical they don't even have a logical payoff. They let you pay the minimums. Of course they let you pay the minimums, then you're in debt the rest of your life. While you're paying the minimum, your debt balloons, and your theory is, oh, I'm going to eventually have a job that pays for all this, but the reality is you don't. And if you don't end up, and bills pile up, people don't get this. Who know, you know, people don't come out of college understanding life. They should, but they don't, because we don't teach the basics of economics. It's not like, for some reason, that's not mandatory. It's same problem in high school. Why is home economics or basic economics not mandatory for every child in America? Why don't they know how to amortize a mortgage when they get out of high school? But they don't. So people go, oh, I've got this student loan, but my student loan will get taken care of, or it's got a low payoff or whatever, blah, blah, blah. And I'm going to get a job and I'm going to have money. But you get a job, you need to get a house, you need to get a car, you need to get suits, you need to get your suits cleaned, you need to eat some food, you need to go back and forth to work. And it's just bill, 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 bill. And people don't know this is going to happen to them. They don't understand it. And they sure as shit don't understand it when they're 18 years old and going to college, where you tell everybody you have to go to college, otherwise you won't get a job. But then they get out of college and they end up having to take a shitty minimum wage job because there's no jobs. Except now, for the job that they didn't actually need a college education for, they have $250,000 of debt. But look, the default rate for those who don't complete their degree is 3 times higher. So yeah, it is good to graduate college. You'll have 1/3 of the default, but you're still going to default, but only 1/3 as much. So this is just all crazy shit. The tariffs are coming, and they're going to start hitting the bottom lines. And again, remember what we talked about a couple of weeks ago. People are scared to be honest, because you might become an enemy of the president if you say, this is because of tariffs. My business is bad because of tariffs. My business is bad because of a bad policy that they put in. You can't say that. You can't risk your whole company. So these guys are doing, in these earnings calls, you were getting the most amazing gymnastics, verbal gymnastics of people trying not to blame the administration for their problems. And it's really amazing. It really is. It's just, I listen to these things, I laugh my ass off sometimes because they're trying not to say that it had something to do with Trump's policies. We expect significant margin pressure from input cost inflation. Consumer behavior is becoming increasingly unpredictable. No, because you can't say that the consumers have no money. You can't say that they're over leveraged. You can't say that the credit scores are crashing and there are so many people who are getting hit. Look, anybody's got these delinquent student loans, these delinquent credit cards, which is 20% of the freaking population. They've got terrible credit scores. They can't buy anything. Everything you buy, all the big ticket items you buy are based on your credit score. They can't put a refrigerator on layaway. They can't put a dishwasher on layaway. They can't get a car. They can't get a house. Can't even get rent. How are you getting out of this? And meanwhile, forward earnings estimates are up to 270 a share for the S&P 500. 303 for next year. So we expect 10% growth, more than 10% growth next year. We're still pricing in this insane growth. It's possible because, again, the oligarchy is efficiently crushing everything and sucking up all the cash. So, yeah, you can have a lot of growth early on. Like I said, Putin's got $100 billion. That's why Trump idolizes Putin. He's got $100 billion. He stole it all. Putin had nothing when he started. He had no money when he started. Being president of Russia was a $100 billion gain for that guy. That's why Trump loves him. That's why Trump modeled his whole thing after that. He's like, you can do this? What do you think Trump is executing now? It's an oligarch playbook. He's doing exactly what Putin did when he came into power. And there are plenty of greedy bastards who are very happy to enable him because they will make billions of dollars too. So tariffs are embedded in our cost, blah, blah, blah. Consumer retail outlet. So consumers are cautiously concerned and nobody understands how this is going to hit everything yet. Musk is brave. He says tariff-driven supply costs. If you're the richest guy in the world, you can speak up. Small business, canary in the coal mine. Yes, of course. And small businesses, again, this $850,000 cost to small businesses, it's not like a bill that they get in the mail. It's $850,000 worth of additional payments, fees, charges, costs that small businesses are getting hit by, that it comes in stages. And what happens to a small business, maybe the business did $5 million, $10 million in business and has 20, 30 employees, and they're going to get $1 million of extra costs. So their costs are going to go up 10%. So either they're going to make 10% less, or they're going to cut their cost 10%, or they'll cut employees. And it's not all at once. It's $100,000 a month. So every month, and it's obviously hasn't hit them yet, but every month it's like this month I'm down 50, this month we're down 60, so we got to do something about it. So we're going to lay off some people, and we're going to do this and that. We're going to spend less of this and that, and we're going to cut the quality of our goods so that the customers suffer. It gets passed on to you one way or another. Or we're going to raise prices so that we don't suffer as much. Whatever form it takes, the consumers get screwed by this. But everybody's shouldering the burden except for the oligarchy that's crushing and sucking this $1 million out for their own profits. That's what's going on. Small business optimism actually rose because of the tariffs becoming less of a problem. But the uncertainty, which is, do you really know what's going to happen to your business, went up to a crazy level. And now they're talking about not even doing BLS surveys except for once a quarter. More time to cook the books. And again, this is not me. I know it sounds like me saying it. This is Bodie's analysis. This is Bodie looking at the overall economic situation and being like, hey, this is really bad. So, oh, in fact, he's even saying that here. E.J. Antonelli, whoever, Trump's nominee to lead the Bureau of Labor Statistics, wants to suspend monthly jobs report, the most important report we have in economics. He wants to suspend it and do it quarterly because he doesn't like the way they're coming out. And look at that, and that's how they're coming out. Since Trump took office, this is how it's been coming out. Coincidence, I'm sure. We're just on the cusp of going negative, and they're suspending the reports. You don't suspend the reports because you've got great data to show people. Suspending the reports means wipeout, means something horrifying is happening. And I know what's happening. It's AIs. AIs are making it unnecessary to hire people for many, many, many jobs. And it's happening very quickly, and it's shocking. And if people knew what was happening, they would want something to be done about it. And I'm not even saying that that's the right thing to do. I employ a whole staff of AIs here. It's freaking great when you're a business owner and you can get all this stuff done without hiring people. But what are the overall economic repercussions? And what is the government's responsibility to mitigate those repercussions? If we say none and we just let everything run rampant, then the economic consequences are going to be a big surprise to us. So consumer discretionary, energy, and industrials are all getting hit. Earnings growth decelerating, tariffs are in, consumers are resilient for now, but they're going more into debt and spending whatever. Market euphoria is still just, what are you going to do? Things are going up, they don't care. And by the way, I sat there all during 2007, and I literally ran out of steam, because this was me in 2007. And in 2008, it got to a point where I was just like, you know what? I cannot, I just, in middle of 2008, right before the crash, like in the summer of 2008, I was literally saying, you know what, fuck it, let's just buy some stuff. I was being all bearish for like a long time. We had a short list. In 2007, we had a short list, and that saved us, really. If it wasn't for that short list, we would have been so screwed when the crash came. But we had a short list. We had a ton of stocks that we were shorted because they were so stupidly high. I was just like, look, at some point, this is all going to collapse. And we kept the short list, and we kept the short stocks, and we had our hedges. But even our hedges, though, we never imagined that the market could go down so hard and fast as it did. It was crazy. But this was me. What I'm saying to you now was me in 2007, in the beginning of 2008, and I said, look at all these signs, look at all this stuff. It's all going to fall apart. It can't be sustained. Yet it kept going, kept going, kept going, kept going. And at a certain point, I was just like, you know what? Yeah, let's buy this, buy that, blah, blah, blah. I regretted all of it. I regretted all the things we bought. I regretted. It was so stupid to go along with the crowd. Big lesson for me at the time. But now I just end up having $170,000 worth of hedges, $470,000 worth of positions. That's where we're at now. We are 100% hedged for a downturn. And as Warren said in his report, and as Brody said today, you're overhedged. He goes, he goes, now you need to buy some stuff. And I kind of agree, but I still have a real bad feeling about all this. So the policy chaos is here to stay. Goldman Sachs is saying 67% of the costs are going to be absorbed by the consumers by the end of the year. 67% of $600 billion. That is a negative stimulus. And here's how July looked. U.S. equities, 2.2%, very nice. Asia without Japan, 2.6%. Emerging markets, 2%. Overall world, 1.3%. Emerging market debt, though, went up 1%. Corporate high yield, cash, Gold was flat. Agriculture bonds bad. Treasury bad. Commodities bad. Arab states, Japan. That's why it's ex-Japan, because if they included Japan, it would be zero. Asia would be bad, and Europe. So basically, Europe bad, Asia bad, including Japan. The EAFF bad, and we're okay. But again, why? Why are we okay? Why are our markets going up? We're in the same world as these guys. So bottom line, AI and mega cap tech are the only growth engines. And again, my issue there, oh, that's funny because he wrote that. My issue there, which Phil calls a circle jerk of capital spending. NVIDIA buys cloud space from Microsoft and Amazon, and Apple buys the chips from somebody, and Apple buys the data center space, and then they build their own data center and buy NVIDIA chips and such for the data center, and everybody's doing deals with everybody else, and the money's sloshing back and forth, and that's why it's a circle jerk. You can't, the same money is just sloshing around in a big giant circle, and everybody looks like they've got this tremendous revenue and these tremendous profits, but you're just recycling the same money over and over again, and it's not, if you can't show a profit, and this is what happened in the dot-com days, right? Everybody was doing this and that with everybody else and partnering with everybody else, and everybody was going to take over every industry and blah, 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 and it all turned out to be bullshit, and it all collapsed. Because adding .com to your name doesn't make you 10 times more valuable. And adding AI to your name doesn't make you 10 times more valuable either. You have to actually produce products that people want to buy. And the consumer is bifurcating rapidly. Small cap companies are getting hit. Management teams are focusing on defense. That's another bad, bad sign. Management companies are automating, getting rid of jobs. They're protecting their margins. They're hoarding their cash. They're not investing in growth. They're defensively playing the game and trying to ride out the storm, and the storm is getting bigger and badder every day. And economic data is no longer reliable. That's a bad thing too. All right, so yep, we're over our limit, so I gotta get off. All right, anyway, that's where we are. That's what's happening. I am cautious, but my robots are telling me not to be as cautious as I am, so we're going to have to find a few things to buy. And as I finish the long-term portfolio review, like I said, we got to find, probably 4 or 5 stocks we want to add to the long-term portfolio and make sure we don't get left behind if things don't collapse. All right, so thank you everybody for coming, and we will do this again next week as we rapidly approach the end of earnings and the beginning of the great Fed rate cut or whatever. That's going to be a biggie, man. All right, take care, everybody. Have a good weekend.